Welcome, everyone. I'm Rebecca Wallenfelsz, a partner at Chapman Cutler in the Trust and Estates Group. My focus is on estate planning, in particular looking at federal and state estate or inheritance taxes. With me is Mike Jankowske. Mike is the president and founder of the Hamelind Group, which provides plan giving resources and strategies to professional advisors like myself, donors, and non-for-profit organizations. But prior to starting Hamlin, Mike was a financial planner and he spent more than 30 years helping his clients rethink their assets and their investments through a tax lens, especially an income tax lens, to help create what he calls tax diversification in clients' assets and investments. So, Mike, first of all, welcome.
Thank you very much. Glad to be back.
Wonderful. So in this video, we're going to dive into some of these, this one particular tax category that we want to discuss in a little bit more detail. But before we do that, would you just give us a quick little overview of what tax diversification means for someone who hasn't seen some of our other wonderful videos before we dive into a particular topic?
Happy to. I'll give you the simple down and dirty explanation. Imagine your wealth being divided and put into different tax categories or buckets, which have similar income tax consequences by putting the money in the bucket, how it grows along the way and how it gets distributed out and how you're taxed. And if you can have a way to have balance by diversifying your wealth among the different buckets, you have more control over paying how much income tax you're going to pay or even capital gains tax over your lifetime. So tax diversification is simply identifying where you are right now with your wealth in these different categories, and then what you can do to reallocate things in such a way to minimize the income tax shock you're going to get when you get a chance to assess it.
Okay, so the category we want to talk today is a category that I feel like is one of the least understood categories. And it's called the non-qualified tax deferred category, right? So that's another mouthful. So Mike, why don't you tell us, what does that mean? What's in this category?
Well, it's very similar in nature to the prior video we did in what we call tax qualified, tax deferred. The non-qualified basically says this. When you invest in a particular investment inside of this particular category, you already pay taxes on the money that you're going to invest in this category. You're going to have a way to tax defer, or what I call tax postpone, the income taxes on the growth or interest rate on what's sitting in that particular category. And then at some future date, you're going to have a combination of principal coming back, but all the deferred growth is going to be income taxed as ordinary income. So the difference in the component is you're taking what we call after-tax money to contribute into those categories, or into that category. There are basically three. Would you like me to explain the three basic?
Yes, tell us
Okay.
what's in this category, because it sounds interesting.
Well, it sounds interesting until you find out some of the good, bad, and ugly about it. But there are typically three things. There's a product called a non-qualified tax-deferred annuity, which means in English, you can take money you pay tax on, you stuff it in there, you could grow it at an interest rate, you can turn around and you can invest in units of a particular, what we call variable annuity contract. You can have an index annuity. In all cases, after tax money goes in, it grows tax postponed until such time you want to take the money out. We'll talk about the consequences of what happens when you want to take that money out and what law changes have taken place when I get further after this explanation. The second one is life insurance, where you could put the same after-tax money into a life insurance product. You stuff it into the product. You can grow it pretty much the same way, and you'll have more fees associated with that product. But you can still simulate the same kind of returns that you're getting in the non-qualified annuity space. The difference is, and I should mention this to make sure there's clarity, when you die with a life insurance contract where you stuff money in, it's totally income tax free to the beneficiary. In the non-qualified annuity, you're going to have an income tax issue of all the deferred interest that the next generation or spouse has to deal with. I should have added that as the definition of the non-qualified annuity. The other category is savings bonds, which there was a series of savings bonds, that you can put money to an individually issued bonds. You'd be tax postponed on the earnings, and then at some point you would liquidate the bond and pay income taxes and all the deferred interest. Some people hang on to those bonds, although that's becoming less and less relevant, hoping that they can continue to sit there and not have to pay the taxes. Unfortunately, with most savings bonds in that category, they reach what we call final maturity, which means they earn no interest or growth, and now they either have to pay the taxes or let the money sit at the same value. So those are the three basic products that you find in non-qualified tax deferred.
Okay. So let's start with this question. Should I have money in this category?
Well, my good all-purpose don't get myself in trouble answer is it depends upon your financial circumstances. I mean, again, if you have a way to assess, which we've mentioned in all the videos we've done so far, what your circumstances are, there are some good fits, but the dollar amount of what you should have in this particular category meets a specific need. I'll give you a couple examples, and I think that best makes you understand how it's very specific to your circumstances, even more so than the tax qualified tax deferred bucket. For example, if you have a lot of money that you're not likely to spend, it's not in a 401k plan or a tax qualified tax deferred bucket. And if you're never going to spend it, you could stuff a bunch of money in a life insurance product, get a return while you're living, and if you need the money, you can grab it. You're going to be taxed no differently than the non-qualified annuity. But the neat thing about that is when you die, not only does the growth and the money you put into that product go to income tax free, but typically there's a death benefit that's higher than the living value. So your spouse, your next generation gets total income tax free proceeds from something you never pay taxes on during your lifetime. Again, it's all based upon the circumstances of will you need the money? Because if you need the money, it gets a little bit ugly when you take the money out, which I'll explain in a minute. Okay. If we take a look at non-qualified annuities, okay, the good news is well, there's no good news on this piece in one respect. When you put money in that and you grow it to a future date, unless you start using the money along the way, you're passing along an income tax burden to your next generation. The only thing you've got working for you from a positive sense is the fact that your heirs can structure a payout that can be spread over a number of years, but you're still going to report the deferred interest as part of a payment. Okay, so that, again, moderation is the key. The income tax brackets of the kids would have a big bearing on this. In theory, you could leave money to a kid that doesn't have as much wealth or income, and if they received a distribution on an annuity product spread over a lifetime or a period of years, they might be far better off and pay little or no income taxes on the deferred interest. Notice the complexity of the circumstances that will drive why you'd use the product. The other part has to do with the thing I talked about with Social Security. Okay, if somebody has a gap period of years between now and the time they're going to get qualified to get Social Security, and you're at the age where you can collect it on a reduced basis, you can purchase what we call an immediate annuity, where you could take some money that's non-qualified, buy a non-qualified annuity, but instead of letting it to defer, you say, I want to give you a lump sum of money, say $100,000, and I want you to pay that to me over 5 years. And the way that works is the annuity company will give you a payment, which includes some interest. It's a combination principal and interest, which means when you get the cash flow back, it's probably more tax favored than any other option you could choose from. But that gives you the cash flow you need to cover your lifestyle needs up until such time that you get the massive reward of collecting 8% more per year on a Social Security benefit. So notice how it's very customized to a particular circumstances for any individual. And that's the part that makes it more complex in dealing with this non-qualified space. So that's the key to that. How do you, and again, if you've overdone it, you have to create damage control to get money out of that particular category and move it to one of the other tax categories without being slaughtered from an income tax perspective. There are a number of ways to do that. We're not going to hold that in this particular session. When we talk about another session, we're going to talk about all these strategies to be able to move things in different tax categories to the more favorable buckets, as you put it. So
Yeah.
that's as much as I can say right now.
Yeah, yeah. And yeah, stay tuned for those videos because that's the key, I think, in tax diversification is you want to look at these buckets, understand these buckets, and then have an assessment of, do I have enough or do they make sense for me? And if they don't make sense, or if I have too much, what are some ways where I can maybe move the money from one bucket to another bucket?
And I will add that history has changed the perspective of how much you stuff in this bucket. I'll give you one clear-cut example. It used to be that people stuffed a lot of money in non-qualified annuities before they
Mhm.
changed the rules, the IRS legislation. It used to be you could say stuff 100,000 in a non-qualified annuity. If it grew to be worth $200,000 of deferred interest, you could actually say, I want to withdraw 50,000 of that 200,000. And the way the IRS would order it from a tax perspective would be, you're taking back 50,000 of your original principal. That was a good deal. You could stuff the
Yeah,
money in, pull all the principal out, but then you still have the problem of all the deferred interest, although that's more manageable. But they changed the rules. And what they said was, well, now that's too favorable. Too many people are stuffing money in annuities. We're going to force you to report any money you take out of a non-qualified annuity as income first,
yep,
principal last. That changed the entire dynamics of why people would want to stuff money in an annuity because of simple tax law change. I think took place in, I'm looking at 96, 94. It's really dating me. But yeah, those rules are gone. It becomes less and less favorable. And again,
yep.
there's so many tactics you can use in that category that we'll be talking about in another session under strategies. Okay. But with that said, any other questions you think the viewers may have, Rebecca?
The only thing I can think of is that this idea that non-qualified annuities have tax efficiencies, I think is an idea that still lingers because I hear that from individuals. And that's where it becomes really important to understand when you do these types of investments about what exactly are the tax consequences of both the contribution, the earnings, and the distribution.
And I think that ties back with the moral lesson we want to talk about. And well, not even a moral lesson, it's the right way to approach this. I mentioned this in the other video about tax qualified, tax deferred, but it's important to mention it every time. You need to have the proper collaboration between a financial advisor, a CPA, and a favored estate planning attorney, but with the right planning tool that properly assesses to what degree you can utilize the non-qualified tax deferred bucket as part of a holistic plan. Therefore, you don't overdo it.
Yep.
You have a game plan, you know what you're going to do. Everybody's on the same page. I've had so many instances over time where, it's damage control that nobody knows that the person stuffed all the money in the non-qualified annuities, except for the person that sold it to them. And now it's like, oh my gosh, we have an estate problem. We have an income tax problem. We've got, and again, the only advantage that you can hope to work with if it gets past the point of no return, meaning the person dies, is the settlement options on the annuity, which is still not the greatest deal in the world.
Agree. Agree.
Yep.
Well, thank you so much, Mike, for joining me today and providing us these words of wisdom.
Well, it's my pleasure, and I look forward to talking more about how we can rearrange things so you can have significant reduction in your income taxes during your lifetime using tax diversification.
Wonderful. Thanks, everyone.
Thank you, everybody. Bye.